yesterday, saying that the city was on the brink of imposing new restrictions to control the virus's spread. So we're going to continue to keep a close watch on that. Meanwhile, some promising news on the vaccine front, countering some of those troubling developments. AstraZeneca and the University of Oxford researchers publishing a study that showed early trials produced two kinds of immune response with no serious side effects. Also, BioNTech and Pfizer reporting positive early data from their vaccine study earlier today. Let's kick things off there. We've got Brian Jacobsen, who is a Wells Fargo asset management multi-asset strategist. He is on the phone joining us today. Brian, it's great to have you on today. I want to start with the vaccine news, though, because we have seen a lot of these vaccine headlines coming up over the last several weeks, giving a big lift to the market today. But AstraZeneca is actually down on the news. Why?
Well, it's interesting as far as the news when it comes out. We also have to look at what preceded that as far as the price moves and what sort of expectations were built in. And I think that some of the price action with some of the biotech companies that are heavily involved in the development of a vaccine or a treatment, there's always like a preliminary report that comes out. And that's, I think, precisely what we saw last week, that there was kind of a teaser of the report that was going to be released in the Lancet as far as how effective the particular treatment was with T cells and with the antibody responses. So it could just be a buy the rumor, sell the news type of event, but nothing that really, I think, is anything for investors to worry about.
Yeah, certainly. A lot of those names, especially in the biotech space, have been quite volatile based on some of the headlines on the vaccine front over the last several weeks. How are you positioning yourself in this space right now?
Yeah, my team, so we look across all asset classes, take a global remit, which is always fun because there's always some opportunity out there. And one of the ways that we're trying to position portfolios right now is just trying to anticipate that with earnings season here, we kind of know that it's going to be a bit of a dumpster fire as far as with earnings. According to FactSet, earnings are supposed to be down around 44% year on year for the S&P 500. And so it's really a question about what does the future hold? How quick of a rebound will we see in corporate earnings? And for my team, we're kind of thinking that with some of the bigger growth names, those that really benefited from people staying at home, that maybe expectations could be getting a little bit too far ahead of themselves as far as what future growth could look like. And as a result, we're really beginning to pivot portfolios more towards those sectors that we think that are have a little bit more headroom, that maybe have been a little bit overlooked. So that tends to be a little bit more over on the value end of the spectrum and a little bit lower as far as the capitalization bands.
So, Brian, to your point about some of the stay-at-home names that you think maybe the expectations have gone a little too far out, what specific names are you talking about? Are you talking about those, especially in the cloud space? You're talking about some of the collaborative software? Can you talk about particular companies that you think maybe the expectations are set a little too high?
Sure. Yeah, I can't talk about specific names that would probably upset our compliance department. But as far as the general themes, I think that you kind of identified it there. We know that there is this move towards online shopping, for example, and the coronavirus crisis really helped accelerate that. It forced people to get a little bit more comfortable with that, or ordering not just online shopping, but ordering other goods and services for delivery online, cloud computing and the such. And to us, it seems like the expectations were pretty reasonable at the beginning of the year, and this accelerated some of the transformation of the way in which consumer spending is done and even business is done. But there's always that danger that investors begin extrapolating that out a little bit too far and maybe a little bit too fast.
Brian, one of the things you highlight in this cautious outlook that you've taken, especially this earnings season, is taking a second look at smaller and more value-oriented companies. What particular sectors are you looking at?
Yeah, so in the value side of things, there is this danger of just going with an index and not necessarily knowing what's underneath it as far as the sector exposure. A lot of the performance difference between, say, growth and value is actually very well explained by sector performance. So it's not necessarily a high PE versus low PE distinction that matters. It's about what sector are you in. And so you do have to be a little bit cautious when you're looking at value, because that does tend to be dominated by things like financials. And we know how banks have done over the last year and even over the last few months. But we are beginning to see quite a bit of value in financials, we think. If interest rates have sort of found a bottom here and we begin to move higher, maybe we could get a little bit acceleration in the movement up of the yield curve. That could be good for net interest margins for a lot of banks. We also like industrials. Industrials, I think, got a little bit overshadowed by the dominance of tech over the last not only few months, but even over the last few years. But there are a lot of businesses that we think that have really done a good job of building resilient business models, and that they could really rebound if we do see a continued improvement in the economic outlook, which we do anticipate.
And finally, Brian, another thing that we're watching closely, just 4 months out from the election, I'm curious how you're calculating the political risk right now. We had that interview from the president over the weekend. Certainly, he's got his eyes on the election. We're seeing the polls with Joe Biden leading ahead. How significant is that downside risk?
Yeah, for our team, we don't anticipate that we're going to see a sweep election where one party is going to be dominating both chambers of Congress and the White House. And as a result, it is likely going to be an outcome of the status quo, which is continued gridlock. We could see changes on the margin as far as with executive orders or the regulatory environment, but most of the changes we anticipate are going to be fairly marginal, at least for the next few years. And as a result, it could be another one of those situations where it's always exciting to talk about, it's always exciting to watch, but at the end of the day, when you get through the election, it probably isn't going to move the markets all that much.
Yeah, it certainly does create a lot of headlines day to day. Brian Jacobsen, the Wells Fargo Asset Management Multi-Asset Strategist, joining us today. Thanks so much for your time.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.